Hey everybody, welcome back to Ryan Makes Sense, where we talk personal finance, investing, and chart analysis. Today we're looking at ticker symbol PBDC. This is an ETF, and we're also going to look at ticker symbol BIZD. This is a viewer requested video. They wanted me to look at these two ETFs, so we're going to go ahead and do that right after I shrink my head and you guys hit the thumbs up or subscribe button. So you can see the screen pretty well. Um, so this stock pays a 9% dividend. However, the expense ratio is a 13.9%. So if we were to dump $10,000 into this stock January 2nd of 2024, that was the first trading day of the year, we would receive $940 in dividends. However, it would cost us $1,394 as in fees to this ETF. Now that puts us underwater. The saving grace here is that this ETF did perform 9.5% for this year. So that is a plus. Is this worth getting into? We're actually going to go ahead and plug this into our expense ratio calculator because I want to give you a visual on why it really does not make sense. Again, this was a really good year. So we're putting in $10,000. Okay. We're not going to put any more in. We're just going to look at this. For example, our duration is 1 year. And our expected returns we do know is going to be 9.52%. Wonderful. This is looking really good. Except for when we get to our expense ratio, it's 13.94%. All right. And that puts our future investment at $10,852. If your yearly expected return is exactly as your expense ratio or even lower, there's no point in investing in this ETF or trust fund. You will not make money. So I'm glad they put that out there because that is very true. You need to watch out for these types of ETFs or individual stocks where there's a high dividend, 9, 10, 15%. But the stock annual is coming down. So you're essentially losing the principal value while getting paid out. It doesn't really add up. It doesn't make sense. So this ETF, although it's paying 9%, you're paying more in fees. It does not make sense. So that was ticker symbol PBDC. We're going to go ahead and refresh this page. And we're going to go ahead and look at our next stock, the BIZD. All right, we are now looking at ticker symbol BIZD. You can see it's been relatively flat for the past 8 years or so, with a major dip back in during the COVID days. Um, this is a similar situation as we were in with the last ETF that we just looked at. It pays you, if we're doing $10,000 at the beginning of the year, we're getting $1,094 back in a dividend. That's awesome. However, we're paying $1,333 in fees. So we're underwater in that sense. Our performance year to date is also not that good. So let's just go ahead and plug this in. Our initial investment, again, is going to be 10,000. Our yearly investment, that was just a one time. We're dropping that. The duration, we'll look at just 1 year. Our expected return was 4.99%. Our expense ratio was 13.33. Did it 13.33. And again, we're getting the same message where essentially if our expense ratio is lower than our return, there's no sense in getting this ETF. And I agree. Um, People do fall into these traps. I mean, there are people literally, where's the volume? There's literally people buying into this. So at the end of the day, you're paying a huge fee to get not like $399 at the end of the day. What happens if this ETF has a down year? Then you're really losing money. So, my alternative and suggestion, I would talk to a professional CPA or someone who's going to charge you money. I would say get into the S&P 500. On average, it grows 10% a year. Very low expense ratio. For example, let's just pull it up. VOO. This is what I would do, and this is what I normally would just suggest to people, not advice. So again, the S&P 500. Oh, look at that breakout. Beautiful. You guys can see that. Yeah. Okay, so we're putting in 10,000. Expense ratio is 0.03. Oops. 0.03. Should be 0.03. Okay, and our year to date is 27.2%. Typically, it would be 10%, but it was an absolutely beautiful year for the S&P 500. So this year, our future investment would be 12,717, and we would pay a $3 fee, not 1,300. So, and we're getting a dividend on top of that, which was 1.22%. So that is again even more of a cherry on top. So absolutely stunning year for the S&P 500. I would look into that rather than those two ETFs. Again, those are traps. There's several different kinds of traps out there. One is high expense ratio ETFs. And then there's also individual stocks where literally the stock pays like a 10, 12% dividend, but it's just been going down over the year. So I would avoid those. Look at other alternatives. If you made it this far, I appreciate you for watching a pretty short video. Hope you guys are having a wonderful holiday. Take care. See you soon. Adios.